Welcome everyone to another crucial update here on Updates with John. Today we're diving deep into a story that's unfolding quietly in the financial world, yet its implications are anything but silent. Imagine a precious metal, a cornerstone of modern industry, sitting in secure vaults from the bustling financial districts of New York to the serene landscapes of Zurich. Now, picture someone in Shanghai, thousands of miles away, desiring that very metal with an intensity that surpasses all others. This isn't just a fleeting market trend, it's a profound shift, a narrative being etched into the annals of economic history, 1,000-ounce bar at a time. When the world's most formidable industrial powerhouse, China, demonstrates an insatiable appetite for a commodity, willing to pay a significant premium that has not only persisted for months, but shows no signs of abating, we are witnessing something far greater than a mere market anomaly. We are observing the very mechanics of global supply and demand being reshaped in real time. And the commodity at the heart of this unfolding drama, the one we absolutely need to discuss today, is silver. Not merely the silver whose price flickers across financial news tickers, though we will certainly touch upon that. Our focus today is on the tangible, physical silver that is systematically being drawn out of Western storage facilities, embarking on transoceanic journeys and ultimately vanishing into the vast network of Chinese factories, never to return to its point of origin. The current dynamics within the global silver market are largely misunderstood by the general public, yet they represent a seismic shift that will inevitably compel everyone, from individual investors to national economies, to confront its reality, whether they are prepared for it or not. Let's begin by establishing silver's current position in the global economic landscape. As of this week, silver has been trading within a range of approximately $64 to $66 per ounce. This valuation, just 18 months prior, would have been considered almost fantastical, a mere whisper of what could be, when the metal was still struggling to break free from the sub-$30 mark. The journey to its nominal all-time high of $121.67 on January 29, 2026, was a moment that sent ripples of excitement through precious metals markets worldwide. It defied the long-held skepticism of analysts who had consistently argued that silver, due to its structural characteristics, was incapable of such a dramatic ascent. Since that historic peak, the metal has experienced a meaningful pullback, a correction that has, paradoxically, created a market scenario of immense intrigue. We now find ourselves in a situation where silver is simultaneously more affordable than it was half a year ago, yet the underlying physical market is tighter than it has been in years. This isn't a contradiction, it's an opportunity, cleverly disguised within the complexities of global finance, and understanding its nuances is paramount. The recent retreat from the January high was influenced by a confluence of factors, many of which bore little relation to the fundamental physical supply-demand equilibrium of silver. The Federal Reserve, under the stewardship of its new chair, Kevin Warsh, maintained interest rates within a steady range of 3.5% to 3.75% at its most recent policy meeting. However, the accompanying hawkish rhetoric was sufficient to send tremors through the precious metals sector. A significant portion of the Fed's policymakers, 9 out of 19, now anticipate at least one additional rate hike before the close of 2026, with market participants increasingly pricing in the possibility of an increase as early as September. Historically, higher interest rates tend to exert downward pressure on precious metals, primarily because they elevate the opportunity cost associated with holding non-yielding assets. When capital can generate a reliable return through investments like bonds, the rationale for holding assets such as silver, which do not offer a yield, becomes less compelling in the immediate term. Compounding these economic pressures was the dramatic resurgence of geopolitical tensions. The conflict that erupted between the United States and Iran in late February 2026 sent crude oil prices soaring past the $100 per barrel threshold, reigniting concerns about inflation. Paradoxically, this period of heightened financial uncertainty saw silver prices suppressed, even as the broader market grappled with instability. A subsequent ceasefire announcement in mid-June of this year offered a brief respite, providing a temporary lift to both silver and gold. However, these gains proved ephemeral, as investors quickly redirected their attention to the Federal Reserve's impending policy decisions. In essence, the precious metals market has been buffeted by powerful macroeconomic forces, and in the short run, these macro trends have largely dictated its trajectory. Yet the nature of the short term is that it invariably yields to the long term, and it is in the long term that the events unfolding in Shanghai assume a far greater significance than any immediate pronouncements from the Federal Reserve regarding interest rate projections. China's systematic extraction of physical silver from the global market has been characterized by a consistency and intensity that should serve as a stark warning to anyone who comprehends the intricate mechanisms governing silver's movement across the world. Both the Shanghai Futures Exchange and the Shanghai Gold Exchange, the latter of which, despite its name, plays a pivotal role in the global physical silver market, have consistently reported elevated withdrawal figures month after month. When metal is withdrawn from an exchange, it signifies more than a mere change of ownership on a digital ledger. It means the physical commodity is literally departing the vault system, moving directly into the hands of industrial consumers, fabricators, and strategic national reserves. Crucially, in the context of China, this silver typically does not re-enter the global market. The most compelling evidence of this phenomenon is the persistent Shanghai premium over the London spot price. Currently, silver traded in Shanghai commands a premium exceeding 10% above the Western benchmark price. Consider the profound implications of this figure. It indicates that buyers within China are prepared to pay a full 10% more for silver than the prevailing global reference price. In an interconnected world characterized by instantaneous capital flows and sophisticated arbitrage strategies, such a substantial premium simply does not endure unless the underlying demand is fundamentally structural, relentlessly persistent, and genuinely outstripping the capacity of the global supply chain to deliver. This premium is not a systemic glitch. It is the market itself communicating an undeniable truth. The question then arises, why is China consuming silver at such an unprecedented rate? The answer begins with the burgeoning solar panel industry, but it extends far beyond that single application. China currently dominates approximately 80% of the global solar cell manufacturing landscape. Every single solar cell produced necessitates the use of silver paste, a conductive material based on silver that is, for all practical purposes, irreplaceable in the fundamental operation of the cell. Furthermore, the latest generations of solar cells, particularly the heterojunction and TOPCon technologies that China has been aggressively scaling up throughout 2025 and into 2026, demand significantly more silver per cell compared to the older PERC technology they are progressively replacing. Some independent analyses suggest that these advanced cells require up to 30% more silver per watt of generating capacity. China's deployment of this technology has been anything but cautious. It has been executed on a scale that defies conventional imagination. Beyond solar, we must also factor in China's colossal electronics manufacturing sector, its ambitious 5G infrastructure build-out, its rapidly expanding electric vehicle production lines, and what appear to be deliberate strategic stockpiling initiatives undertaken by state-affiliated entities. In China's overarching industrial strategy, silver is not merely another commodity. It has been implicitly and increasingly explicitly designated as a strategic material. In January of 2026, Beijing enacted new export restrictions on refined silver, mandating government licensing for any silver exports. This measure effectively ring-fences a substantial portion of China's domestic mine supply for internal consumption. This is far from a minor regulatory adjustment. It represents China employing a strategy reminiscent of its approach to rare earth elements, tightening export controls, securing internal supply, and transforming a raw material into a potent instrument of geopolitical leverage. The global ramifications of this strategy are immense. China is not only the world's largest consumer of silver, but also one of its largest producers. When a major producing nation simultaneously consumes more than it produces, restricts its exports, and actively accumulates strategic reserves, the global supply equation is fundamentally altered. The rest of the world, including economic powerhouses like the United States, Europe, and Japan, along with countless other nations reliant on silver for their own industrial ambitions, must now contend for a progressively smaller pool of globally traded metal. And they must do so while China, backed by the immense financial might of the world's second-largest economy, continues to absorb available supply with relentless efficiency. If you have been tracking the silver market for any considerable period, you will recognize that this is not merely an interesting anecdote. It is the defining narrative that will shape the future trajectory of this market. However, the situation becomes considerably more intricate and urgent when we consider the impact of this eastward flow of physical metal on the exchange that effectively dictates the silver price for the entire Western world. Stay with me, because the second critical piece of this puzzle involves a vault system in New York that has been under a quiet yet persistent siege for many months. What is transpiring there provides crucial insight into why the current market setup for silver may be more significant than anything witnessed since the dramatic events of 1980. In the heart of Manhattan, within a building on its southern edge and in the subterranean vaults beneath it, as well as similar approved facilities scattered throughout the New York metropolitan area, resides the physical silver that is meant to underpin the vast volume of futures contracts traded daily on the COMEX exchange. These vaults and the meticulously tracked figures detailing their contents are not abstract financial statistics. They represent the tangible bedrock upon which a colossal paper market operates, a market that sees an almost incomprehensible volume of silver change hands every single week. And right now, the story these vaults are telling is one that the prevailing price on your screen is not fully encapsulating. According to the most recent data released by the exchange, the registered silver inventory at COMEX stood at approximately 82 to 86 million ounces. This figure has seen some fluctuation over the past several weeks, particularly as the July 2026 delivery cycle prompted a reclassification of eligible metal into the registered category, making it available for immediate delivery. However, context is paramount, and the broader context here is profoundly revealing. Earlier in 2026, the registered silver holdings at COMEX had dipped below the 90 million ounce mark for the first time in many years. This represents a dramatic decline from the peak frenzy of early 2021, when over 500 million ounces were briefly visible within the system. The overarching trend, despite these recent minor fluctuations, has been an unmistakable and persistent downward trajectory over the medium term. Now, let us turn our attention to the ratio that holds the most significant implications for this market. The COMEX silver futures market currently boasts an open interest that represents roughly 268 million ounces of notional silver exposure. When juxtaposed against the 82 to 86 million ounces of registered deliverable metal, we arrive at a coverage ratio that fluctuates between approximately 15% and 30%, depending on the specific day the data is observed. In simpler terms, this means that if a substantial proportion of contract holders were to simultaneously decide to demand physical delivery of the metal to which their contracts entitle them, the exchange would undoubtedly face a crisis of unprecedented historical magnitude. The sheer volume of paper leverage currently superimposed above the physical foundation of this market is staggering. According to the latest exchange monitoring data, this paper leverage currently stands at more than 6 times the available deliverable supply. The COMEX has operated under this model for decades, and the system has, thus far, avoided collapse primarily because the overwhelming majority of participants in the futures market never actually intend to take physical delivery. Their primary objective is price exposure, and they typically roll their contracts forward or settle them for cash long before any physical delivery obligations come due. The entire intricate architecture of the modern commodity futures market is predicated upon this fundamental behavioral assumption. The assumption that most participants are, in essence, bluffing. And for the most part, they are, until of course they are not. This is precisely where the narrative of Shanghai and the saga of COMEX converge into a single, compelling story that demands your serious and immediate attention. When Chinese buyers are willing to pay a premium of 10% or more for physical silver over the established London benchmark price, they are not doing so out of a mere aesthetic preference for Shanghai over London. Their motivation is far more fundamental. They desperately need the metal, and they need it now. This persistent premium acts as a powerful financial magnet, inexorably drawing physical silver from every conceivable source towards the epicenter of this intense demand. And yes, that includes the silver currently residing in COMEX-approved vaults in New York. The underlying mechanics of this process are remarkably illuminating. A sophisticated trading house, possessing established relationships in both New York and Shanghai, can execute what is essentially a global arbitrage strategy. This involves purchasing silver in New York at the prevailing COMEX price, arranging for its shipment, sometimes via London, sometimes through Swiss refineries where the bars are recast to meet the precise specifications of Chinese exchanges, and then selling it into the Shanghai market at a premium. Even after meticulously accounting for all associated costs, including transportation, insurance, and refining, this arbitrage leaves a significant and attractive profit margin. When such an arbitrage window remains wide open, metal moves with astonishing speed, and crucially, when it moves from New York to Shanghai, the registered inventory at COMEX diminishes, while the vault inventory in Shanghai correspondingly increases. This is not mere speculation. This is the observable mechanism through which the global silver market is currently functioning. The data from early 2026 provides vivid and concrete evidence of this trend. In a single month during early 2026, the United Kingdom imported approximately 601 tons of silver from the United States, with almost all of it subsequently re-exported to various Asian markets. London, in this scenario, was not acting as a consumer of this metal. Rather, it served as a critical logistical relay point, a temporary way station on the arduous journey from Western vaults to Eastern factories. Every single ton that traversed this pipeline served to reduce the physical backing beneath the Western paper market, further exacerbating the underlying imbalance. Now, let us address a critical question. Why can new supply not simply rush in to alleviate this growing imbalance? This particular aspect of the silver story is one that most investors dramatically underestimate and often misunderstand. Silver is not primarily extracted as a standalone product from dedicated silver mines. In fact, a substantial majority, roughly 70% to 75%, of all mined silver originates as a byproduct of mining other base metals, such as copper, lead, and zinc, as well as gold. This fundamental characteristic means that the overall production of silver is largely beholden to the economic fortunes and operational decisions within the mining industries of these other metals. For instance, if copper miners decide to curtail their output because prevailing copper prices do not adequately cover their operational costs, then, as an unavoidable consequence, silver output will also decline, irrespective of what the price of silver itself might be doing. The silver market therefore possesses almost no inherent ability to independently and rapidly escalate its production in direct response to signals of its own supply shortages. The primary silver mines, those operations where silver is the principal economic driver for excavation, constitute only a modest fraction of the total global supply. Furthermore, the establishment of a new primary silver mine is not a matter of months, it is a monumental undertaking. The process typically involves extensive exploration, navigating complex permitting procedures, undergoing rigorous environmental reviews, securing substantial financing, undertaking arduous construction, and finally commissioning the operation. This entire life cycle regularly spans a period of 7 to 10 years from the initial discovery to the commencement of first production. Consequently, there is no effective short-term supply response mechanism within the silver mining industry. The global silver cupboard, once depleted, refills at an agonizingly slow pace, if it manages to refill at all. The Silver Institute, widely recognized for publishing the most comprehensive annual accounting of global silver supply and demand, has consistently documented that the global silver market has been operating under a structural supply deficit for multiple consecutive years. The aggregate demand stemming from diverse industrial applications, robust investment buying, the jewelry sector, and silverware production has persistently outstripped the total supply derived from both mining operations and recycling efforts. This widening gap has been historically bridged by drawing down existing above-ground stockpiles, essentially the silver that was mined in previous decades and meticulously stored in vaults, held within exchange-traded funds, ETFs, and maintained in various private holdings across the globe. When we observe a decline in COMEX inventories, we are, in effect, witnessing this very process in action. The accumulated buffer, which once provided a cushion against supply shortfalls, is being systematically consumed, drawer by drawer, to satisfy a relentless demand that the mining industry is simply incapable of matching. Recycling, which might appear to be another logical safety valve, faces its own set of structural limitations, particularly pertinent in the current market environment. The silver embedded within solar panels, for example, is notoriously difficult and economically unattractive to recover. The silver content per individual panel is minuscule, and the panels themselves are engineered for an operational lifespan of 25 to 30 years. Moreover, the necessary infrastructure for the efficient end-of-life recovery of silver from photovoltaic panels is, in most markets, either nascent or virtually non-existent. Silver, utilised in various electronic components, presents similar formidable challenges to recovery. A significant proportion of the silver consumed industrially each year is, for all practical purposes, permanently removed from the recyclable supply chain. It becomes an integral part of a rooftop solar array in a province like Shandong, and from that point onward, it effectively ceases to be a part of the circulating, recoverable supply. Therefore, the current arithmetic of the silver market in mid-2026 paints a stark picture. We are confronted with a structural supply deficit that has been ongoing for several years, a deficit that is now compounded by steadily declining COMEX registered inventories. This situation is further amplified by a persistent Shanghai premium, which continues to exert a powerful pull, drawing physical metal eastward at a pace that refiners and global logistics networks are struggling to accommodate. And critically, there is no meaningful new mine supply anticipated to come online in the immediate future. These are not merely marginal pressures, they are interconnected forces that compound upon one another, creating a feedback loop of tightening supply. And yet, despite these profound underlying dynamics, the price of silver, as of this week, hovers around the $64 to $66 per ounce mark. This apparent disconnect between fundamental reality and market price is precisely what makes this moment so compelling and potentially transformative for those who understand its true implications. This intricate dance between East and West, between paper promises and physical realities, is not just a fascinating economic case study, it is a harbinger of potential shifts in global financial power and industrial strategy. The relentless demand from China, driven by its ambitious renewable energy targets and technological advancements, is effectively draining the reservoirs of readily available physical silver. This is not merely about solar panels, it's about a nation's strategic imperative to secure critical resources for its long-term growth and geopolitical standing. The implications for the rest of the world are profound. Nations that have historically relied on a seemingly abundant supply of silver for their own manufacturing and technological needs will increasingly find themselves competing in a market characterized by scarcity and escalating prices. This competition will not only impact industries that directly use silver, but could also ripple through various sectors, affecting everything from electronics to medical devices. The current market dynamics suggest that the traditional mechanisms of price discovery and supply response are being challenged in unprecedented ways. The paper market, with its vast leverage, has historically absorbed shocks and provided liquidity. However, when the physical underpinning of that market begins to erode, the stability of the entire system comes into question. The Shanghai premium is not just a number, it's a distress signal, indicating a fundamental imbalance that cannot be ignored indefinitely. It highlights a growing divergence between the perceived value of silver in Western financial markets and its actual, tangible value in the industrial heartland of the East. This divergence creates a unique opportunity for those who can discern the underlying trends and position themselves accordingly. The narrative of silver is no longer just about inflation hedges or safe haven assets. It is now intrinsically linked to global industrial policy, technological innovation, and geopolitical competition. The quiet movement of silver bars across oceans is, in fact, a loud declaration of a new economic reality. And understanding this reality before it becomes front-page news is what truly sets apart the informed from the unprepared. The future of silver, and indeed a significant portion of global industry, hinges on how these converging forces ultimately resolve themselves. The stage is set for a dramatic revaluation, not just of silver, but of the very assumptions that have governed its market for decades. And we, here at Updates with John, will be here to break it all down for you, every step of the way. Stay tuned, because this story is far from over. So, what does all of this mean for you, the viewer, and for the broader financial landscape? It means that the traditional metrics and assumptions used to evaluate the silver market are undergoing a profound transformation. The disconnect between the physical reality, characterized by relentless demand, dwindling inventories, and structural supply deficits, and the current market price, which remains relatively subdued, presents a fascinating paradox. This paradox is not sustainable in the long run. History teaches us that fundamental supply and demand dynamics eventually assert themselves, often with dramatic consequences. The current situation in the silver market is a ticking time bomb, not in a sense of impending collapse, but in terms of an inevitable revaluation. The question is not if, but when, the paper market will fully reconcile with the physical market. When that reconciliation occurs, the impact on prices could be significant, affecting not just investors, but also industries reliant on this critical metal. Furthermore, this story extends beyond mere economics. It delves into the realm of geopolitical strategy. China's actions in securing its silver supply are a clear indication of its long-term industrial ambitions and its desire to reduce reliance on external vulnerabilities. This strategic stockpiling and control over exports are part of a larger pattern observed with other critical resources, signalling a shift in global power dynamics. For other nations, particularly those in the West, this necessitates a re-evaluation of their own resource security and industrial policies. The days of taking abundant, cheap raw materials for granted may be drawing to a close. Understanding these intricate connections between industrial demand, financial markets, and geopolitical maneuvering is crucial for anyone seeking to navigate the complexities of the modern world. The silver market, in this context, serves as a microcosm of broader global trends, offering valuable insights into the forces shaping our future. Here at Updates with John, our commitment is to bring you these deep dives, to peel back the layers of complexity, and to present you with the unvarnished truth about what's truly happening in the world. This isn't about sensationalism. It's about providing you with the knowledge and context necessary to make informed decisions. The story of silver, with its quiet movements from Western vaults to Eastern factories, its struggle between paper promises and physical scarcity, is a testament to the ever-evolving nature of global commerce and power. We encourage you to stay informed, to question the prevailing narratives, and to look beyond the headlines. Because in understanding these subtle yet powerful shifts, you gain a clearer perspective on the bigger picture. Thank you for joining us for this critical update. We'll continue to monitor these developments closely and bring you the latest insights as they unfold. Until next time, stay vigilant, stay informed, and keep asking the right questions.